Good morning, everybody. We're going to wait another minute or so because we have a few stragglers.
Hi, Rita.
All right. Well, maybe we'll just get started and hopefully the rest of the people will just trickle in. But good morning, everyone. I'm Lisa with Center State CEO, the Director of Events and Programs. Today, we are presenting a webinar in our business tactics programs. The actual title is What's Next? Financial Succession and Transition Planning Strategies. This webinar is being brought to us by UBS Services. For all of you that don't know Colette, Colette Powers, she's with Powers Wealth Management and UBS Financial Services. Colette's professional and personal experience has truly shaped as a financial advisor. Her passion is helping families discover and create their own life map and building a personalized financial plan to support it. So before I hand over the program over to Colette and her colleagues, just want to let you know that this is being recorded. Please put your questions in the chat box, and at the end of the presentation, we will actually answer your questions. So I'm going to hand it right over to you, Colette. All yours.
Okay, thank you, Lisa. Hi, everyone. Good morning and welcome, and thank you for taking the time for joining us today. As Lisa said, my name is Colette Powers, financial advisor, Powers Wealth Management at UBS, and I'm a certified exit planning analyst. And I am just thrilled to be able to speak to you all today about one of my most favorite topics, and that is business succession. And I truly believe, given the challenges of these past 6 months of what business owners have had to face, that I do think it's a topic that's on their mind as well. And they realize now more than ever the need for planning. And that's why I've asked Brad Dillon from UBS Financial Services and John Harubin to join me here today. Both have vast experience with business succession. I asked Brad, I'd like to begin by introducing Brad, and I asked Brad to join us because I liked him to speak about what I like to call the why now aspect of our presentation, because there are some compelling reasons why business owners should seriously be contemplating business succession today. But before I do that, let me tell you a little bit about Brad's experience and expertise, and I'm just going to read from here, okay? Brad earned a BA in mathematics and philosophy from Indiana University, summa cum laude, and a JD from UCLA School of Law, where he was an editor of the UCLA Law Review, and he earned a Master's of Law in Taxation from NYU School of Law. Brad works with ultra-high net worth families, helping them achieve their tax, estate planning, and philanthropic objectives. Brad focuses on developing and implementing creative and comprehensive wealth transfer strategies that align with clients' wishes. He reviews clients' tax and estate planning documents to ensure that each plan accurately and holistically reflects the family's philosophy and needs while maximizing tax efficiency. So, Brad, I'll let you take it away, and I'll ask you my question. Why now?
Well, thank you, Colette, and thanks for everyone joining or listening in later on the recording. This is the Why Now, of course, is, I don't know if any of you have tuned in or watched the news, but we have an election coming up next month, and that's going to really impact precisely what we can do even in the next few months, and particularly in the next several years. So all of that introduction and background that Colette gave, it all just sort of sums up and say, I'm a tax lawyer, and I help business owners each and every day find ways to transition their businesses to the next generation in a tax efficient manner. And one of the ways that we can do that, of course, is by giving sort of expediting the gifts that you might leave under your will through an inheritance, and expediting some of that planning into your lifetime. And one of the biggest reasons, the benefits of tax planning, what I can say is, and this I tell my students, I'm also an adjunct professor at Fordham Law School where I teach trust and estates. I often tell my students that the number one tool in my toolbox as an estate planner is to tell my clients to gift their wealth as early as possible and as much as they're comfortable with. So as much wealth as you're comfortable parting with as soon as possible. And I'll get to why that is. But one of the things I like to think about is the IRS. I'd like to think about it as a tax man or a tax woman coming along at your death, tallying up everything that you own. So your investment accounts, your furniture, your jewelry, your cars, your homes, your real estate, your business interests. They tally up everything up. They take the sum total. And the federal government says, thanks, I'm going to take 40% of that. And maybe if you live in a state that has a state level estate tax, like New York, for example, the New York state will say, thanks, I'm going to take 16% of that. And so we're dealing with a very massive tax regime where you might be working with Colette or another financial advisor at UBS or somewhere else, and they might be trying to get you sort of annualized returns in the high single digits, maybe low single digits would be phenomenal every year over year. But my job is to sit with Colette and others and say, but what about when you die and the 50% of it or half of your wealth is going to be taken away at that point and given to the government? You're sitting here trying to achieve year over year, but we have to think holistically long-term too. And so my job is to think about that big chunk that the IRS is going to take at death. So tallying up everything that you own and taking that big chunk. What do we do about that? Well, the easiest thing, the number one tool in my toolbox is to make the pot that they take from smaller. So all of your wealth is, just imagine in a big pot of assets. And I want to make that smaller and smaller and smaller by the time you die. Why? Well, because when the IRS takes a sliver of that or a big chunk of that at your death, the assets are smaller. They're taking a smaller chunk. If it's bigger, they're taking a bigger chunk, right? That's really the basics of all the law school, all the training I've done in NYU, everything I tell my students, it comes down to really just shrinking that pie so that the slice that the IRS takes is smaller. Well, how do we do that? Like I said, we accelerate the gifts that we would maybe normally make during at our deaths, under our wills or revocable trusts. Instead, we accelerate those to now, during our lifetime, as soon as possible, as much as possible. And why is that? Well, as soon as you make a gift during your lifetime, you take those assets that you gift and you put them outside of your estate. So immediately already, when the tax man or woman comes along and tallies up everything you own, the asset you've gifted isn't part of the tally. So you've already shrunk that pot. So you've already shrunk that pie so that the slice is smaller. But even more than that, the big double whammy of the effectiveness of this accelerating gifts during your lifetime is that the appreciation. The moment you gift those assets till the moment of your death, all of that appreciation also happens outside of your estate. So again, when the tax man or woman comes along and tallies up everything that you own, if you gave away $1 million worth of Apple stock today, but by the time you died, it was worth $5 million, that $5 million would have hugely grown that pie. It didn't. In fact, it shrunk the pie when you made the gift, and it grew somewhere else outside of your name. And so my job is just to help any of our clients figure out the best ways to do that. And in fact, business interests are some of the most incredible assets to plan with. I want to talk about, and I'll talk about why in a moment, but I want to talk about why now, to Colette's point. Why is there any urgency? I just wrote a piece I think that Colette will link to or send you all to at the end of this presentation, which is called "The Estate Planning Should Be an Urgent Priority for Wealthy Families." And an urgent priority should have been in bold, underline, and italics, because it is, this election, so much is at stake in the election because of course, the Democrats and Vice President Biden have all proposed making these rules, these tax laws that we're planning with, much less favorable. So let me tell you what that looks like. So when I say you want to accelerate your gifts during life, the IRS puts a cap on the amount that you could do that without also incurring a tax. And right now, it's called the exemption, the gift and estate tax exemption amount. Right now, that exemption amount, the amount that you can give away during your life without the incurment of any taxes whatsoever, any transfer taxes, gift or estate taxes, is at an all-time high and a historic high of $11.58 million per individual, or $23.16 million for a married couple. That's the amount of wealth that you can part with right now without incurring any gift or estate tax. So imagine your pie of wealth, you can massively shrink it, way more than you've ever been able to. Well, what's going to happen if perhaps Joe Biden takes the White House and the Democrats take over the Senate? Of course, they maintain the House. Well, all of a sudden, their goals, their plans are to make that $11.5 million that you can give away gift tax free. They want to shrink that by 70% to $3.5 million. So instead of being able to give away and shrink that pie by a huge amount, you can shrink it just a little bit less. So again, the effectiveness of being able to accelerate those gifts, it becomes less advantageous under a Democratic administration. So despite your politics, and I'm not trying to be partisan at all here and saying that, really these are just the facts, which is that we're living under a regime this year in 2020 because of the Tax Cuts and Jobs Act in part, and because of the inflationary adjustments to that estate and gift tax exemption, that we're living under a regime that is incredibly tax favorable. So my job, of course, is to tell everyone, you have this moment, this moment before the election, before things could potentially change, to take advantage of these laws and shrink the pie of wealth to something more manageable, so that when the IRS takes that chunk, it's a little bit less painful. And so that's a big part of it. And so they want to lower, the Democrats want to lower the exemption amount to $3.5 million. What does that look like? So suppose that and I'll talk about this in a moment, but suppose that the exemption amount were to decrease to $3.5 million per person. So $7 million from a married couple. So that would mean that, suppose that it all became done on January 1st, 2021. So I'm just looking at two examples. One example where a couple gives away the maximum amount they're able to on December 31st, 2020. Under the favorable rules that are in existence this year, after the Tax Cuts and Jobs Act, they were able to give away that maximum amount. So $23.16 million, they gave it all away. Compare that to the same couple who says, never mind, I'm going to wait till January 1st, just one day later. And they say, I'm going to give away the maximum amount that I'm able to part with without incurring any gift tax. Well, by then, it can only be $7 million. What does that look like? What does that mean? Just by planning one day earlier, that couple that gave away $23 million versus the $7 million immediately saved $6.5 million in taxes. Immediately. Just by taking advantage of the laws one day earlier, they're able to save, because the difference between 23 and 7, and you multiply that by 40%, that's about $6.5 million. So that's the real benefit of actually planning under these heightened exemption amounts this year versus next. So what are the conditions that need to be met to actually take advantage of this, or for those changes to happen? I get this question all the time, which is, well, Brad, sure, I think I'm watching the polls. I see that, and at UBS, I think in their election watch team has come out and said that there's a 50% chance they believe, a majority chance, or plurality anyway, of the Democrats taking control of both the Senate and the White House. And so if we believe in that, we're all watching the polls, and you say, well, fine, that may happen, but that the Democrats aren't going to get into office till after January 1st, 2021. And then they're going to have to deal with a pandemic and a recession, or worse, possibly a depression, or all of these things. And then they're going to have to get to tax reform, right? So you're sitting here saying that I have to think about it as January 1st, 2021, but in fact, it looks like the Democrats aren't going to even be able to enact tax legislation until sometime much later in the year. Well, my response to that is, well, yeah, of course, but what are they going to do? When are they going to make that tax legislation effective? Well, there's no constitutional hurdle whatsoever to enacting tax legislation retroactively. And in fact, they've done it twice before. And once in the 80s and once in the 90s, in the gift and estate tax context, they have enacted retroactive legislation before. So there's no constitutional hurdle. The Supreme Court has looked at this several times and said that there's no bar in the Constitution itself, which means that tax laws must be prospective instead of retroactive. And so there we have it. And there's this massive urgency, it seems, that we've just spent trillions of dollars to combat the pandemic and the economic fallout from this pandemic. And so it seems to be some urgency to raise additional revenues. And so I think that a lot of us, at least in the gift and estate tax world, really believe that this will be sort of low-hanging fruit, right? They've been talking about how favorable the estate tax and arena is for so long, so many years, that it's kind of low-hanging fruit to just say, let's change the rates, let's change the structure of it just a little bit. I want to just caveat that no constitutional hurdle to retroactive tax legislation for anyone on here who might be a stickler about it, which is that there is one bar, which is that you cannot institute retroactive tax legislation if it's for a wholly new tax. So if you invent a new kind of tax, like a VAT or a wealth tax, if you invent that wholly new tax for the US, then you can't make that retroactive, because the Supreme Court says that you can rely on the laws as they exist. The rates and the brackets, they can be changes, little changes here or there to those structures to existing tax laws, but wholly new tax laws can't be made retroactive. So we're not likely to see a wealth tax next year. I doubt we're likely to see it under a Biden administration anyway, but just for any of you out there who might be wanting to challenge that. The second piece is that people say, well, yeah, but what about filibuster? So tax legislation is very controversial. It's also very partisan, it turns out. And so won't the requirements and demands of the Senate require 60 votes to overcome filibuster to get that cloture requirement to overcome filibuster? Well, we all know that in the news anyway, there's been a lot of talk of completely undoing the filibuster, eliminating it entirely, exercising the so-called nuclear option and doing away with it. So that's one possibility why we wouldn't need 60 votes. But the bigger possibility is we don't even mind. You don't have to get rid of filibuster, because for tax legislation, as it's been done under the Tax Cuts and Jobs Act, as it's been done under the Bush tax cuts, they use a process called budget reconciliation. Budget reconciliation is a process where you create a budget and you have to reconcile the existing tax laws with the new budget. If the budget demands that the tax laws change, you can do that without requirement of filibuster whatsoever. What that means, you need a bare majority in the Senate and the House to pass legislation, with, of course, with the president's signature. So what does that mean? We're really looking only at a need for 50 Democratic senators, or 49 with Bernie Sanders as the independent. So that makes it seem more likely, if you're paying attention to those polls, that we could get to 50 with a Vice President Harris, if that were the case, breaking that tiebreaker in the Senate. So just some procedure and constitutional rules there to put at play that this is a real risk that we're looking at, that these favorable laws could really change as of January 1st, 2021. Because even if they don't get their act together to enact tax legislation until September, October, November of next year, we're really looking at them making it retroactive to January 1st, 2021, which means that we have the rest of October, November, and all of December to plan with the favorable laws with any certainty. And so there is the real, that's why I said we should underline, bold, and italicize that urgent priority. And that wealthy families, estate planning should be an urgent priority for wealthy families and business owners. Precisely because of that. We have these very favorable rules in existence right now that we know are there with certainty, that will be there with certainty, that won't be challenged if we take advantage of them by December 31st of this year. Starting January 1st, the clock resets. We don't know what's going to happen. Of course, that's assuming that Biden wins the White House and the Democrats take control of the Senate. And so with that big assumption, that's what we're kind of looking at. So what does the window of opportunity look like? Again, it's just we have these next few months. What does that mean for you all as business owners? I think that it means that I hope that you all are speaking with your financial advisors and your trust and estate attorneys today. And if you haven't, to pick up the phone and call them today. I talked to a lot of them who are very, very busy. And so it's nice to just get this process started. And what does it look like for business owners anyway? Why did I say these laws are so much better for business owners? Well, right now we have that $11.5 million per person to give away gift tax free, to give to the next generation, to charity, whomever you may want to benefit or trust for their benefit. Get those assets out of your estate. Well, business interests are excellent ways, particularly in a privately held business. Why? Well, because the IRS says, well, how much did you give away? Well, you have to figure out, well, what was the value of that gift? And you have to go get that value by a valuation firm. You have to go get your business interests appraised. Well, the IRS uses a willing buyer, willing seller test. And so it says, well, we're going to assign a value to it based on what a willing buyer would actually pay in the market for that privately held business interest. And what does that look like? Of course, they say, Well, it's a private asset. It's really hard to sell because there's no public exchange to go and just do a sort of quick market exchange here. So we should give a discount to value for lack of marketability. It's not as private interests aren't as marketable as non-private or public interests are. And so you get a discount to value. And I'll talk about what that means in a moment. But the second thing is, if you give away something less than a controlling interest, so less than just 50% or less interest in the business, the IRS as well, also an evaluation firm will say this too, which is it's going to be harder to sell that too, right? It's going to be even less marketable. Not only is it a private asset, but it's a one that you will have absolutely no control in. You won't be able to vote those shares in any effective way or control the business with your votes, which are less than 50% vote, less than a majority interest. And so they're going to give you another discount to value for lack of control. These lack of marketability and lack of control discounts often go in the range of 30 to 40% of discount of value. So for example, supposedly you gave away $100 worth of interest in your business, but you got those discounts for 30%. You only have to eat up $70 per share or partnership interest or whatever it is of your business, eat up $70 of the exemption. That means you get to leverage that exemption. So that 11.5 million suddenly becomes 17 million, or that 23 million suddenly becomes 30 million that you can give away just by leveraging that. And even though you've gotten $100 per share or $100 of partnership interest into the trust or out of your hands, out of your estate, you've only used up a smaller portion of your exemption. So it's an incredible way to leverage your exemption. It's a way, leveraging the exemption that way has been blessed by the IRS multiple times. They tried to shut it down under the Obama administration, and that was not successful. And then Trump reaffirmed the ability to do that. And so we have this, these sort of incredible laws that are in existence right now, just for the next little over 2.5 months to take advantage of. And business interests are an incredible way to do that. Being able to gift those interests to trusts that benefit your family or to charities can produce a lot of good, because again, you get those assets out of your state, you shrink that pie, you get the future appreciation out of your state so that it happens somewhere else. Okay, so you're saying, fine, Brad, you're telling me to give away millions and millions of dollars of my wealth during the middle of a pandemic, right? During the immense economic uncertainty, right a month before the election. Are you crazy? And I'll say yes, a little bit, but the point is that you can still give away a lot of your wealth and still there are ways to structure those transactions so that you can keep sort of what we call in the trust and estate world, sort of backdoor policies, which are, one example of this is that if you're, for example, you're a married couple, suppose the husband wants to give away his business interest to a trust that benefits his family, he can do that so it benefits his wife and children, or his spouse and children, so that, if a distribution, or if it turns out you had donor's remorse where you sort of regretted giving away so much of your wealth, you lived too long, you lived into into the hundreds, and you said, my God, I needed more money than I thought I needed, I didn't plan for this properly, then, well, what you do at that time is you say, assuming your wife in this case is still living, make a distribution to my wife of the assets in that trust. She can give them to you. There are zero tax consequences affiliated with that transaction. And so that's just one way. There are many other ways to sort of have a backdoor policy, whether you're married or not, depending on the state you live in or not. And so there are lots of ways to be able to give yourself a little bit more comfort that you're parting with so much wealth during a period of uncertainty, but that if it came, push came to shove and later on you needed some of that money back, some of those assets back, you could rest assured that that ability was there, that you could take it if you really needed it to do it. There are other ways. Insurance is a possibility, just to be able to produce extra assets at death. So there are lots of ways to structure these transactions so that you can have a maximum comfort, but also by minimizing your estate tax liability. And the final benefit of all of this tax planning, of course, is that it's creditor protected. If you put assets into a trust that benefit your family, if one of those family members goes through a divorce, or one of those family members has, sort of a slip and fall case or gets into an accident, aren't properly insured, and suddenly you have creditors coming after them, whether it's a divorcing spouse or someone else, someone slips and falls in your property, whatever it is, they won't be able to access the assets in that trust. And that's a really important part of planning, particularly for business interests, which are, you can protect these assets from potential future creditors minimize your estate taxes, and give yourself the comfort that if you absolutely needed, you could get those assets back. And so to come full circle of what I tell my students, which is that the number one tool in my toolbox is to part with your wealth as soon as possible and as much as possible. As much as possible because you want to shrink that pie as much as you possibly can. So giving away as much of your wealth, utilizing as much of the available exemption, which is right now $11.5 million per individual, using that to the maximum effect that you can. You don't have to use it all up if you don't have that wealth, but some of it, while it's available to us right now, is going to be a crucial part. And then using it as soon as possible. So don't wait. Don't wait till later on. Don't wait till next year. Don't wait till 5 years from now, even if the Republicans don't take control, because you get those exemption amount, you get that wealth out and all of its future appreciation. So the sooner you do it, assets tend to appreciate over time. The sooner you do it, that appreciation happens in somebody else's name. Okay, I'm going to round this out and turn it back over to Colette. But the final piece of this that I'll say is that people often say, well, this is great, Brad, but what if I do all of this planning? What if I give away massive chunks of my wealth or business interests to the next generation? What if I do all the things you say and the Democrats don't take control? What if Joe Biden doesn't win? What if they don't successfully take control of the Senate? Won't all of this have been erased? And my answer to you is no. I don't. This is a presentation I would have given you last year, 2 years ago, 2 years from now, 5 years ago. And it's not about the election. It makes it more urgent now because we see on the horizon a potential change that could make the tax laws less favorable. But I'd be telling you the same thing in any normalized environment, which is make gifts as much as possible and as early as possible for the same reasons. The estate tax has been in existence for 104 years this year. It has changed here and there, but the overall structure has remained pretty sound over that time. It may go away, but it likely comes back in times of need. And it's unlikely to go away when we have, again, this massive need for some fiscal, for some fiscal revenue in the federal government. And so my advice is always the same, which is if the estate tax is going to be there, it's always best get assets out of your name early so that depreciation happens outside of your estate in someone else's name, and get as much as you can out. So again, you reduce the size and the amount that tax man or woman tallies up at death so that you have to pay a smaller chunk. Your family gets more, or charities get more according to what you want. And so I think I will round it off there. I'm happy to answer questions at the end of this, but I'll turn it back over to you, Colette.
Okay. Thank you, Brad. I appreciate that. It's always great to witness your passion. I love that. Next, I'd like to introduce John Harubin. John is with EdgePoint, which is a UBS Financial Services M&A partner. And I had asked John to come here today to talk about what I like to call, Brad discussed the why now, why it's important now to plan, but then what would be next? If a business owner was contemplating a succession, what would be some of the steps that he or she would have to take to ensure that they had a successful succession? But before I do that, what I'd like to do is I will tell you a little bit about John. And again, I'm going to read. So John manages client transactions, leads business development initiatives, and provides leadership for the EdgePoint team. He leverages his technical and business experiences to identify and advise companies contemplating ownership transitions through a sale, an acquisition, or a management buyout. He has a proven track record of delivering creative and innovative solutions to middle market businesses with a focus on entrepreneurs and closely held family enterprises. And again, so I've asked John to come here and talk about what's next. John, I am going to pass it over to you. And so tell us, what are some of the things business owners should be thinking about when they're thinking about succession?
Great, thanks, Colette. Appreciate the opportunity to be with you today. I'm a much less accomplished educator, or less passionate educator than Brad is. So I'm going to use some slides. Lisa's going to help me walk through some slides to illustrate some of the concepts I'm going to share with you this morning. As Colette said, kind of building on what Brad was talking about, when you're looking at, or a client's looking at, their future succession plan and transition plan. oftentimes meeting those goals so that you have money to give to charity or take care of family or meet retirement spending needs. Business owners are going to need a liquidity event to achieve those goals. So that's kind of the area I'm going to focus on, is when people want to consider that. And the rules, or at least some of the aspects of that, have changed a little bit, like everything in our world, because of COVID. So I'll talk a little bit about some of those changes that have occurred recently. Just by way of background, we're based in Cleveland, although I've had a lot of experience in upstate and central New York. We've advised over the years clients in from Buffalo, Rochester, Binghamton, Rome, Saratoga Springs. So a lot of business we've spent, a lot of toll road time we've spent. I had a son that graduated from RIT several years ago, so also spent a lot of time there. And then we have some dear friends in Skaneateles. So definitely enjoy the people as well as the businesses we've worked with, in your backyard there. The first slide I have up here is just really a snapshot, so you get a sense of who we are and what we do day to day. As Colette mentioned, we're a boutique investment bank, meaning we just focus on a certain segment of the market. And most of what we do, at the top of the page there, it says, the services we provide. We have 25 people here, 25 people in the firm. We work nationally, although we're based in Cleveland. We have clients in California, Texas, Connecticut, Florida, so really coast to coast, and even internationally. We have clients in Mexico and Canada, and we're working with a company in Belgium. So we talk to a lot of different buyers because most of what we do is sell-side representation. And for our clients, that could be selling to someone who does the same type of business that they do. It could be private equity or investors that want to buy and maybe operate a business like that, or family office, a family that has a lot of money that's looking to invest and buy and grow businesses. So 90% of what we do is representing sellers in that capacity. Much like Brad, I'm a recovering CPA and attorney, as is the background for a lot of the folks here at our firm. We've all worked at much larger places, worked with publicly traded companies, but a lot of folks here at some different points in their career, the guy that founded our firm grew up in a 3-generation family business. I consulted with family businesses for a bank for many years. So we've just found that we like taking the knowledge we've gained in working in larger environments. It's just a lot more satisfying helping entrepreneurs and owner-founded businesses and family businesses achieve whatever the goals are that they want to, as part of the financial planning and strategies they're working with Colette and Brad. So that's kind of the focus of what we do. Next, you can go to the next slide, Lisa. And the types of businesses we do this for, given we started here in Cleveland, we have in the Midwest in general, we have a tremendous background in industrial and manufacturing. So any type of metal or manufacturing type businesses across a number of different sectors we've probably worked with over time. We have a consumer products group that works with a lot of food and beverage and packaging and consumer products, business services, which is inclusive of distribution. We're market with a staffing company right now. So that a lot of different areas we cover there. We have a healthcare group and an energy group. So we see a fairly broad spectrum of types of businesses we talk to as part of what we do. So we end up creating, when we represent our clients, we help them sort through these issues and create a competitive process to where we're talking to potentially multiple buyers at one time, making sure they're legitimate buyers. And so we're having literally hundreds, if not thousands, of conversations with different types of buyers, and the same questions and the same issues keep popping up over and over. That's kind of the value we bring to our clients as part of that, our discussions. You can go to the next slide, Lisa. We kind of say we're very simple folks here. We roll up, we're blue collar investment bankers. We roll up our sleeves and get stuff done. So when people come to us and say, hey, I think I'm ready to look at or contemplate a liquidity event, we really we pull up from 10,000 feet and we say, look, there's 3 legs to a stool. We want to make sure we address before, you move down this path. And one is, is the business ready for, a potential liquidity event or sale? Is the owner ready to do that? And is the market ready? And when there's alignment amongst those, or some level of alignment, is when we say, okay, there's now is the time to consider doing this. And, we look at all the different aspects of those areas before we move ahead. So that's kind of the first cut we take when we're looking at it. You can go next slide, Lisa. Part of the advice and consulting and things that Colette and Brad are doing are really, for the first leg, is the owner ready? And what we found working with, again, hundreds of families and entrepreneur-founded businesses, there's a lot of math involved with figuring out, do you have enough money to retire on? What would you need to sell your business for? What is it worth today to do this? But, time and time again, we've been, I wouldn't say surprised, but, the amount of emotion that's involved in this process is, has to be balanced as much as the math, if not more in many instances. So these here are just a few of the things that, clients that we deal with look at is very important in determining, what their goals and objectives are to determine whether they're personally ready to do this. So a lot of folks care about their employees, people that got them there to, that point in their, their business cycle. People love confidentiality. They're, don't want their neighbors or people knowing about what's going on with it. So confidentiality is a critical component a lot of times. Legacy, we hear this time and time again, and again, part of the charitable strategies, Brad referenced, and I'm sure Colette sees in talking to people is, if it's a third generation business, people say our family's name's on the door. We have 100 families that rely on us. If we're going down a path to do something, we want to make sure it's good for our employees and our community or charity. Again, balancing part of this with all those is important. Our goal is to make sure people can still, when they're done with going through a process, they're still able to get together at Thanksgiving and celebrate as a family. So that occasionally that doesn't happen, but that it's better to address and communicate and identify potential issues before you go down a path. And the upper left there is highest price. And we'll talk about that in a minute. All these other things are important, but invariably 9 out of 10 times price does end up being an incredibly important factor as part of the assessment as to whether the owner's ready. So is it going to be enough? So you can go to the next slide, Lisa. Kind of the second leg of that three-legged stool I talked about is the business ready? And these are just some, certainly not all of the critical areas you need to look at in determining whether a business is ready to would be attractive to potential buyers in the market at any given time. And it's too simplistic to say it's akin to selling a house, but for ease and of explanation and time here, we'll use that analogy. So there's a certain amount, just like when you sell a house, there's a certain amount of staging that occurs. You want to clean up the house before people start walking through and doing things. So there's a lot of areas in a business that can be addressed prior to initiating a transaction process, to help make sure you're ready. Brad mentioned a lot of, certainly a lot of tax planning that can go into that to make sure, when something does happen, your goals in that area achieved, or it's at the most tax efficient manner that it's done. There's sales and marketing components, legal issues. Do you have the right entities? S corporations, C corps, LLCs. Is real estate owned or part of the business? So is it owned in the business, or is it owned in separate LLCs? So there's a lot of legal matters that need to be addressed so that they don't end up, a lot of these things, so they don't end up being problems down the road. We have to look at ahead of time and resolve or prepare. Certainly on the financial side, there's a lot of things to look at. So what some of these things might look like in my house analogy is, this is akin to, do you have do you have inventory that you need to clean up? Do you have to have kind of a garage sale before you sell the business? Is there things that need need to be addressed there? Some people say, should I buy that new machine before if I'm getting ready to sell the business, or start a new product line or a new service? Should I buy a new building? I'm outgrowing my current facility. Should I do that? Should I hire that new salesperson or a general manager or a CFO? So part of this is, do you remodel your kitchen or your bathroom right before you sell the house? So we help people assess, is that, are you going to receive a return on your investment? Are those types of decisions going to help the value of the business ultimately, if you go down a path to do that? So this would answer the aspects of whether the business is ready. You can go the next slide there. Kind of this what I'm going to start talking about now here is goes to, is the market ready? And as I mentioned, the olden days, I tell people in the olden days, like January, the easiest part of the leg to answer was, is the market ready? Because there was, for the last several years since the Great Recession, merger and acquisition, sales and acquisitions of businesses has been growing and steady. There's just tons and tons of money out there that has been put to use buying businesses and growing businesses. The economy has been growing steadily over that period of time. So that was always the easiest of the three aspects there to answer. And we know, we've learned that the sale of a business is typically going to be the largest economic and emotional event, for a lot of our business owners in their lifetime. So determining what value is in the market and determining whether the market's ready is critically important. Just in a very simplistic view here, I'm going to walk through, how's value calculated for most businesses. And it's really, there's a number of different ways. Accountants value certain ways. We look at it as, what's the market gonna pay? What's a willing buyer and a willing seller gonna pay? So it's, and the most common way to do that is this formula here. It's called a multiple of Ebitda. And Ebitda is an acronym for a business's earnings before interest, taxes, depreciation, and amortization. And then value is typically determined as a range of that. So you figure out what that EBITDA number is, and then you apply a multiple to it. So if your EBITDA is $1 million, and I have here, for a particular industry, EBITDA might be 5 to 7 times EBITDA is how people are valuing those businesses. So the value of the business at $1 million of EBITDA would be between $5 and $7 million. Now, EBITDA and what we do, and we work with accountants to do this, and the owners, is kind of, it can be adjusted. A lot of owners, in talking, people don't like to pay taxes. So, a lot of entrepreneurs and private businesses and family businesses are run to minimize taxes. And so oftentimes financial statements show what, the least amount of profitability possible. Our exercise is to show the maximum amount of profitability possible. And that EBITDA, or the net income, gets adjusted for things like discretionary owner expenses. People sometimes have children on the payroll that aren't necessarily, doing much for the business. Their boats or their club dues, or just different things are run through the business legally, but things and expenses that a new buyer wouldn't necessarily incur if they bought it. So that EBITDA, if you didn't have to pay taxes, what's the maximum amount of value you can show? So that's what could be adjusted to that. And I have listed there on the bottom is that buyers, will look at this EBITDA. It's typically a 12-month look back. So you see what you've done over the last 12 months. Unfortunately, the Great Recession taught us, what have you done for me lately? People don't trust, what's happened a number of years ago. And obviously COVID has reinforced that, that concept. So they look at this EBITDA over the last 12 months. So it may span over, over a couple different periods, but buyers will look at several years in the back. because if they're going to be paying you, theoretically millions of dollars for your business, they're going to want to know that, the profitability or the income has been steady, predictable, recurring, and maybe growing over time. And they will pay, if you look at that range I said of 5 to 7 times, they will pay, closer to 7 if you have those types of attributes. So size matters in this value discussion. There's different buyers for businesses that have $1 million of EBITDA or less than there are at 2, than there are at 5 million, or there are at 10 million. So it becomes scale and who can afford it and things like that. So that's what we help do, is assess who the right buyer pool would be to do that. So this is how historically and even today, value for a sale is generally determined. So as you can see, even at $1 million of EBITDA, getting 5 or getting 7 times could have a meaning. And as the EBITDA grows, getting 5 or 7 times that could have a meaningful impact on both future value and taxes and financial planning, going forward. You can go to the next slide, Lisa. Thanks. So what we've seen, and this is pre-COVID, but it's also post-COVID, is people say, well, how do I get that highest price? So in addition to making sure you're ready and the business is ready, these are some of what we've noticed these are the attributes. It's not all inclusive, but these are probably the more common ones that we see. The more of these attributes a company possesses, the more likely we can advocate and argue that, a buyer should pay to the higher end of whatever an EBITDA multiple might be for the business. So one is growth, the ability to say, hey, if someone else came in to buy this business, I've got some ideas to help it grow going forward, either through different services or different products, doing something different. But being able to articulate that is helpful. Acquisitions, this is very big now. Unfortunately, some businesses are struggling. So we know of some folks that say, I have a competitor. I know they're struggling a little bit. If we added their territory or their product line onto ours, we'd be bigger. We'd have bigger EBITDA. We'd be more valuable. So the ability to sort of identify some of those strategic acquisitions now could be helpful. Predictable revenue. So if you have a product or service that gets used over and over, buyers find that value in that. Long-term contracts. Those don't exist as much anymore, but if you've had owners that have a long-standing relationship with their customers, we look at it as kind of a sticky relationship, and that's viewed favorably by buyers. Leadership, businesses where an owner can leave for vacation for a couple weeks and there's other people there to help run it, also tends to gain more value. There's risk if an owner's making every decision for a business, hasn't delegated decision-making responsibilities. If something happened to them from a buyer's perspective, that's a big risk. The business might fail. So they're going to pay less for that than if you had key employees to help. If there's something proprietary or patented about a product or a service that a business has, there's value in that. If you're in a niche that requires certifications or licensing that's hard to replicate or acquire, buyers find that attractive. A big one now too is low, and it always has been, is low customer concentration. So again, in the Great Recession, people that had 80% of their business with Ford or one of the automotive companies, and suddenly cars aren't getting made nearly at the level they were, that's a huge risk. Business can drop off very quickly. So having many customers and not all your eggs in one basket limits the risk and would encourage a buyer to pay more. Quality data, that's having good financial statements, good books, knowing how you make money, just showing, being able to prove that, the EBITDA we're talking about is really there. And then competition, having someone like an investment banker or an advisor talk to multiple buyers, create competition, just like back to my house sale analogy, if you, excuse me, you don't take the first offer that walks in the door, you may want multiple offers to compare and contrast and have people know that, that they're in competition is another way to increase value. So those are, there's other ones, but these are the ones that, again, at a higher level, owners should start considering when assessing whether, they're going to be attractive in the market. You can go to the next slide, Lisa. So this is the, our what now slide. And, again, pre-COVID, the market was really hot, very active, lots of, I hear different numbers now, Brad, I've heard of $1.5 trillion of money is sitting on the sidelines for people to buy and invest in companies. So we still we think there's a robust, buying community out there for businesses of all different sizes. We've seen M&A activity be very, continuing to get strong. Some areas, obviously, energy, oil went down, leisure, restaurants, those kind of things, have struggled through COVID. But there's, so there's been a pause in some of those, but there's others that have remained strong. So, buyers and investors are going to look at, I mentioned certainty here and predictability, which will, make sure they feel like they're going to get a return on their investment for whatever they have. So given, as I indicate here, given the slowdown, buyers are going to be very skeptical, the sustainability of EBITDA for the short term once we get out of the pandemic. So people, we've had people say, well, look what I was doing before COVID, I'm going to get back there. And buyers are going to say, well, we'll believe it when we see it. So for right now, we're just going to pay you, on what you're doing. So, buyers are going to look to adjust EBITDA and find ways to push that down. So, and see, people have to know what the future impact of the pandemic is going to be on their business. So there has been a pause and there has been some adjustment in the market. You can go to the next slide, Lisa. So, what should an owner do? And in today's market, what we've seen, and again, we've seen this done successfully, is that there's going to be a slight adjustment or modification to how value is calculated. And so that acronym, that EBITDA acronym is now we're seeing called EBITDAC. And the C part of that is going to represent, kind of what the temporary or one-time impact that COVID has been on a particular business as a result of the pandemic. So, we're finding that owners are becoming better at, or some of them at least are, if they can demonstrate that they were prepared and flexible to, weather the storm of the pandemic and emerge in a number of instances intact, they're going to be in a better position to attract buyers. So we're part of what we do, we've been recommending clients get what's called a quality of earnings. So if they decide now is a good time, we'll have an accountant come in and kind of just validate at a point in time that EBITDA number is accurate. It's different from an audit. Audit tells you what was happening at 12/31, doesn't tell you what's happening today. This quality of earnings will give comfort to a buyer that the EBITDA we present is valid today. And then questions that are going to happen in any industry is they're going to say, again, what was the disruption, to your supply chain? We've had some businesses, we have a packaging company we represent that, packaging, at least for what they do, the business hasn't grown, but because they didn't have any Asian supply chain exposure, kind of made in America or packaged in America, people started rushing to them. So their business unexpectedly grew because, they were the domestic supplier or domestic packager for their particular industry. So we've seen a lot of kind of odd things pop up in the market, because of what happened. Buyers are going to ask what impact, and sellers should know, to your customers and suppliers and vendors. What was COVID's impact to them, and how are you addressing that? And then again, how is your industry overall impacted by this? And then a lot of businesses, because they had to zig and zag with remote workforce, is did you incur any costs relative to the pandemic to keep your business operating? Did you have to put in any new systems or replace suppliers or vendors or do things? So those costs would be considered one time, and we could use those to adjust EBITDA favorably for clients, and again, try and show the maximum amount of EBITDA when we're negotiating. So we have seen we've closed 5 deals in the last 45 days. Some of them were ones we had started pre-COVID. There had been a pause because, owners wanted to find out what was, or buyers wanted to see what the impact was going to be. And then some of the businesses, rebounded and are doing well. So businesses that are, able to demonstrate this capability or be prepared to show, how they're getting through this, are going to be in the best position to get, a premium value. Ironically, one of the deals we closed recently, and I'm going to wrap up with this, is that we had a company, and this is publicly disclosed, so in Colorado, that makes custom countertops. So we had a buyer at the table in March. We thought construction was going to be totally on hold. And the buyer said, we're going to pause and tap the brakes until we see what happens. Our client just kept doing their thing. So we were talking to them periodically, every couple of weeks to see what happens. And lo and behold, they had their best April and May ever. And we were scratching our heads, and the owners, and they sold 50% through Home Depot. And as it turns out, with everybody working at home, stuck in their kitchen or dining room and saying, for the foreseeable future, I'm going to be stuck here. I'm not going on vacation. I don't have commuting costs like I did. We're going to refresh the kitchen or whatever. So we weren't expecting that, and we ended up selling it, a publicly traded company. Our EBITDA went up. We were able to demonstrate that we think for at least the next couple years, we have visibility that EBITDA, this wasn't a one-time spike because of COVID. We were able to negotiate our client to a higher end of that valuation range, and the publicly traded company paid all cash for the business. So there's been some anomalies because of what's been going on with COVID. The last thing I'll say is that if you are contemplating a sale, or someone the PPP loans, there's a lot of rules, tricky rules around those with the SBA. Your legal counsel and your accountants, we're aware of these rules too. Those need to be navigated as part of the process at the end to make sure you don't trip up and you're able to get the sale done. So anyways, I'll stop there, and likewise, if there's any questions, happy to address those. So thank you.
Well, thank you. Thank you, John. Yeah, it's been interesting times, on the winners and the losers that COVID has brought to the table. But thanks for sharing those. I like those 10 points that I think regardless of where we are, whether COVID, pre-COVID, in COVID, post-COVID, there are those basic 10 things that I think are, true to really being helping business owners prepare for their succession. So Lisa, I didn't know, do you want to open it up for question and answers? If anybody has any questions or answers, please feel free. You can unmute, I guess, Lisa, or put it in the chat.
Yep, either way, they can unmute or put it in the chat.
And I think also too, what you mentioned yesterday, Brad, if anybody wanted to have a question later on, feel free. You can get my contact information from Lisa, and I can also follow up with you that way. John, what kind of industries do you think have been, more activity because of COVID?
Well, it's been of those deals I mentioned that we closed, a couple are healthcare related. One was, we just closed this last week in New England. It was a multi-location behavioral health addiction therapy place. And as it turned out, because it's very adaptable to telehealth, it received a ton of interest, in the market. So that ended up, being good. Food packaging, we have, a deal that it's a food packaging, safe packaging, and that kind of stuff's been very resilient and in greater demand. But even construction-related stuff, a couple of the deals were companies that supply parts to construction, across a broad spectrum too. So,
Right. And valuations, I guess, really determine based on the industry if it was impacted positively or negatively, right, to COVID, like your countertop company.
yeah. And although one thing that's been surprising, a lot of people said, well, I don't want to sell now because people are going to think I'm in a disadvantage and they're going to give a low value. They're going to think I'm forced to sell. And again, because there's so much money and so much competition, we've actually seen those premiums held up.
Mm.
So again, that's a good surprise that people are still willing to pay for those businesses that are performing well. So it hasn't had as much of an impact
As you thought it would have. That's interesting, right? Because of the amount of activity out there. And then, Brad, I'll ask you as well, just the famous question about that wait and see in the election. And I know you spoke to it, but any last parting words on that approach?
For sure. I think a lot of people, when I tell them the story that I've told you all today, are saying, well, great, well, I'm just going to wait and see what happens. I don't want to plan and part with a big chunk of my wealth only to see that on November or something, we're going to find out that maybe Trump still wins the White House or the Senate did not take control of the Senate. And the first thing I say back to those people when they sort of, have that incredulity, I say, well, when is that going to be? You're going to wait and see, wait until when? After the election? Well, when is that? Right? We don't know. And there are, many stories, of course, these days of, will it be the night of November 3rd? Most people, of course, are saying because of the mail-in ballots, probably not. Will it be November 4th or 5th or 6th? We don't know. So you're waiting until an unknown time. But secondly, more importantly, like I said, I would tell you this regardless of the election. Parting with your wealth as soon as possible, as much as possible, is the number one tenet, like I said. So it doesn't matter if there's an election. If you're doing it while the tax laws are still advantageous, you're still getting the bang for your buck of that, using that exemption, getting that appreciation outside of your estate while you can today. So it doesn't matter if the election's coming up or not. But at least if you really are strong, have a strong mind about waiting and to see the results, to pull the trigger, at least get yourself to a position where you can just pull the trigger as soon as the results are announced, right? So that you can get the trust set up that benefits your family or the charitable organizations that you want to set up and benefit. You can get those things set up now. So that you could fund it, the day after the results if it turns out that it favors the Democrats. Or you can sort of wait if it doesn't favor the Democrats. You can then have more time to figure out what you want to do. But at least get yourself to that point. And the final thing I'll say is I've talked to many trusted state lawyers. I've alluded to this. They say that if the Democrats do take control of the Senate and the White House, they're going to literally turn their phones off the hook, take them off the hook, because they will be so overwhelmed with inquiries to do tax planning. So get in before the hustle. Get in right before all of that happens, so that you can be in a spot where you can actually pull that trigger. To effectuate a sophisticated estate plan, it takes more than days. It takes weeks, right? So get yourself there ahead of the game, so that you can put yourself in position to pull that trigger when the time comes.
Great. Well, I want to thank everybody for participating, and then also for maybe future viewers of the recording of this presentation. And I think the message is really, if you are thinking about it, there's always, being prepared in anything and in any situation in life. And I think with what Brad's talking about, and I talk about that with my clients, it's you deal with the situations and the rules and the guidelines that we have now, right? I mean, we know that life is dynamic. It's not static, but we have to have a starting point at some time, right? And knowing your number and what you need to get from your business, for me, from a financial planning perspective, I think is one of the most important things. And then we can engage the expertise of John in preparing your business, and then Brad in how to do that in a tax efficient way. So I hope this information was helpful. I really appreciate John and Brad. Thank you for bringing along your wonderful expertise. Love working with you guys. And Lisa, I'll give it back to you.
Thank you. Thank you to John, Brad, Colette, all three of you for being here this morning. I do, before we close, just want to let you guys all know that we have another member exclusive this afternoon in regards to our candidate series. So you can still participate in that, as well as upcoming is our Economic Champions event that we're having. So don't forget to nominate yourself or an economic champion. And then obviously just a few ways to stay connected with us, additional resources, our toolkit, upcoming events, and then any questions, obviously you can email me or support@CenterStateCEO. So that's all we have today. Thank you, everybody, and we'll see you all soon.